All right, let's get right into it. Today, we're going to talk about a massive shift in your trading. We are moving away from that chaotic, gut-feeling kind of trading that just bleeds accounts dry and into the structured, disciplined process that the pros use day in and day out to stay consistent. So let's do this.
And honestly, there's no better place to start than with this. This quote from the legend Paul Tudor Jones, it's everything. It really gets to the heart of what professional trading is all about. It's not about hitting that one monster trade, it's about playing defense, protecting your money so you can show up and play the game again tomorrow.
It's such a painful question, right? We all hear this advice. But the second we're in a live trade with real money on the line, it all goes out the window. And I think the reason is we get so obsessed with finding the perfect entry signal that we completely ignore the process that actually keeps us from blowing up.
Now look at this. The really dangerous thing here is that these mistakes don't happen one at a time. Oh no, they create a domino effect. You forget a stop loss, which turns into a huge loss. That makes you angry, so you jump back in, revenge trading, with a position that's way too big. And just like that, one small slip-up snowballs into a massive, gut-wrenching drawdown. It's a vicious cycle.
And this, right here, this is the light bulb moment. Just trying to be more disciplined is a losing fight. You can't outmuscle your own emotions when the market is going crazy. The real answer is to build a system, a set of rules so concrete, so non-negotiable, that your feelings just don't matter. You're not making a decision, you're just executing the plan. Okay, so let's start building that system. The very first piece of any professional trading process is all about one thing: survival. Plain and simple. Because you can't win the game if you're not in it.
And your survival plan rests on these two pillars. Think about it. A written trading plan is like a contract you make with yourself. You figure everything out when your mind is clear and calm before the market's chaos can mess with your head. And your risk management? Well, those are the steel guardrails that keep you from driving off a cliff when a trade goes south.
You're looking at what might be the single most important number in all of trading. The rule is dead simple. You never, ever risk more than 1% of your entire account on any single trade. When you do this, any one loss is just noise. It's an ant bite, as one pro trader calls it. It keeps your head straight and your account healthy. So that sounds great, but how do we actually do it? How do we stick to that 1% rule? The answer is position sizing. This is the tool that turns that abstract 1% risk into a concrete trade size. It means you risk the exact same amount of money whether your stop loss is 20 pips away or 100 pips away. It completely standardizes your risk every single time. And here's the math. It's not complicated, I promise. It's a simple 3-step process you have to do before you even think about hitting that buy or sell button. Step 1, what's your 1% risk in actual dollars? Step 2, based on the chart, where does your stop loss need to be? Step 3, you just plug those numbers into the formula. That's it. All guesswork, all emotion, gone.
Okay, so our risk management is locked in. Now we can get to the fun part, the analysis. See, pros don't just stare at one chart. They view the market from multiple dimensions, through different time frames, and that gives them a huge edge. Let me show you what I mean.
This chart just lays it out perfectly. That lower time frame, say the 15-minute chart, it's chaos. It's full of noise and fake-outs. It's great for pinpointing our entry, but that's it. The higher time frame, like the 1 hour, is where we get our context. It shows us the real story, the big, dominant trend. It cuts through all that noise and tells us which way the river is actually flowing. So if you're a day trader, this is an absolutely killer combination to start with. It's simple and it's incredibly effective. You use the 1 hour chart to decide your bias. Are we buyers or sellers today? And then you zoom into the 15-minute chart to hunt for that perfect, precise entry.
So, step 1, you always start here, on the higher time frame. You look at your 1 hour chart and you ask one question: what is the trend? In this example, you can see it clear as day, a series of higher highs and higher lows. That tells us everything we need to know. The market is bullish and we should only be looking for chances to buy. Period.
Okay, now we switch gears. We drop down to the 15-minute chart. We already know we want to be a buyer, but we don't just jump in anywhere. That's a rookie mistake. Instead, we wait. We patiently wait for the price to pull back, to take a little breather and consolidate. We're waiting for our moment. And this is our trigger. Once price is consolidated, we watch for a big, strong, decisive candle to break out to the upside. That's our confirmation.
That tells us the buyers have woken up and are back in control, and the uptrend is ready to continue. See how this layered process just stacks the odds in our favor? It's powerful stuff.
All right, let's level up a bit. The market isn't just a bunch of random squiggles on a screen. It's driven by massive institutions, banks, hedge funds. And if we can learn how to spot their footprints, we can start to trade with them instead of against them.
To follow the smart money, you have to understand the concept of liquidity. You can think of liquidity as the fuel that makes the market move. It's basically big pools of orders, especially stop-loss orders, that are just sitting there above old highs and below old lows. The big institutions need to tap into that fuel to fill their gigantic positions.
And this is how they do it. It's a classic move. If you've ever been stopped out of a trade only to watch the market immediately reverse and rocket in your original direction, yeah, you've probably been the victim of a liquidity sweep. Price will purposely spike into one of those zones, trigger all the stops, and then slam the other way. It's a stop hunt, and it's designed to trap retail traders before the real move begins.
So if the liquidity sweep is the action, an order block is the footprint it leaves behind. It's a very specific candle or price zone that appears right before a huge, explosive move. Think of it like this. If a big bank placed a massive buy order right there, they are probably going to want to defend that price level if the market ever comes back to it. That's why these zones can act like magnets for price.
So we've got risk management, we've got analysis techniques, but here's the thing. None of it means anything if you don't have a consistent routine to apply it every single day. This is the real secret that separates the amateurs from the pros. Just look at the structure here. A pro's trading day isn't just one long, chaotic event. It's broken into 3 deliberate phases. First, there's preparation, where you analyze and build your game plan. Then comes execution, where your only job is to follow that plan. And finally, the most important part, the review, where you learn and get better for tomorrow. This isn't gambling, it's running a business. So, let's wrap this all up. What have we learned? It all starts with remembering that your #1 job is to be a risk manager. You do that by trading a system, not your emotions. You gain your edge by getting clarity from multiple timeframes and learning to read the institutional footprints. And the glue that holds it all together? A disciplined, consistent daily routine. That is what turns knowledge into true mastery.
Look, you've got the blueprint now, but knowing this stuff is one thing, doing it is another. So I'll leave you with this question. Out of everything we just covered, what is the one single rule that you are going to write down, tape to your monitor, and commit to following starting your very next trading day?